Ever had your check bounce? It's not just embarrassing, it's expensive. One minute you think the money's there, and the next, the bank hits you with fees. Your balance drops, and you're left wondering what went wrong. In today's episode of Jay Get It, we're breaking down why checks bounce, what happens behind the scenes when the system says no, and most importantly, how to stop it before it ever happens again. So, what does bounce check actually mean? When you write a check and there's not enough money in your account when it's deposited, the bank rejects it. That's what we call a non-sufficient funds or NSF check. It's like promising a payment your account can't deliver. The check literally bounces back unpaid. And that rejection doesn't just disappear. It sets off a chain reaction of fees, flags, and frustration. Let's pull back the curtain on what happens when you hand someone a check. Every check you write travels through a clearing network, usually handled by the Federal Reserve or another check processing center. When that check hits the system, your bank gets a digital ping. Hey, does this account have enough money to cover the payment? If the answer is no, the payment fails and the check comes right back. The merchant or individual who tried to deposit it now has an unpaid item and you've got a return check fee waiting in your account. So what's the damage when a check bounces? First, your bank fee. That's usually between $25 and $35 depending on the institution. Then, the merchant or payee fee. If your check bounces at the store or a landlord's office, they can charge their own penalty, sometimes even more than your bank did. And it doesn't end there. If you bounce multiple checks, your name can end up in check systems, a national database that tracks risky banking behavior. That can make it harder to open new accounts, qualify for overdraft services, or even switch banks in the future. Let's talk about why this happens, because most of the time, it's preventable. Reason number 1, insufficient funds. The most common, maybe your deposit hasn't cleared yet, or you miscalculated your balance. Reason number 2, deposit hold. You deposit a check, but your bank puts a temporary Regulation CC hold on the funds. You assume the money's available, but it's not. Reason number 3, post-dated check cashed early. Remember our last episode? If someone deposits your post-dated check before the written date, it can bounce if your balance isn't ready. Reason number 4, account closed or frozen. If your account was recently closed or flagged for suspicious activity, any outstanding checks will automatically be returned. Reason number 5, fraud or alteration. If the bank detects a mismatched signature, altered amount, or counterfeit check, they'll reject it for your protection, but it still counts as return. When that check fails, a few things happen, and they're not fun. Number 1, the receiver's bank returns it unpaid. Number 2, your bank deducts an NSF fee. Number 3, your balance drops even lower. Number 4, you might trigger additional overdraft or negative balance penalties. And number 5, the payee may report the unpaid debt to collections. And if a business transaction, that can mean a broken trust between you and your landlord, employer, or vendor. So yeah, a simple mistake can cost real money and credibility. Now, let's fix it. Because avoiding a bounce check is easier than fixing one. Tip number 1, always know your balance. Use your bank's app to check before writing a check. Don't rely on memory, balances change fast. Tip number 2, set up overdraft alerts. Most banks let you receive text or push notifications when your balance drops below a set amount. Tip number 3, wait for deposits to clear. Just because a deposit shows pending doesn't mean it's spendable. Always confirm funds are available before issuing a check. Tip number 4, communication with the payee. If you know your funds are tight and it's okay to ask the other person to hold off a day or two, it's better to be honest than to bounce a payment. Tip number 5, don't rely on float time. Many people think checks take days to clear. Not anymore. With electronic clearing, most checks are processed the same day they're deposited. Tip number 6, keep a small buffer. Having an extra $100 to $200 in your account can protect you from unexpected timing issues. For my bankers and tellers watching, this is where education makes a difference. Every bounce check is a learning opportunity. Instead of just applying a fee, take a moment to explain what happened, the timing of deposits and withdrawals, the importance of available versus ledger balance, how overdraft protection can help. When members understand the why, they make smarter financial choices and fewer checks come back. That's a win for both the member and the institution. Here's a quick story. Lisa wrote a $700 rent check on Monday. Her paycheck was set to deposit Tuesday morning, or so she thought. But the landlord deposited immediately. By Tuesday, her rent check had already bounced. She ended up paying her rent plus a $35 bank fee and a $50 landlord penalty. Lesson learned. Don't assume timing will work in your favor. Always check, verify, and communicate. Bounce checks don't just cost money, they affect your financial reputation. Repeated NSF activity can make your bank see you as high risk, which limits your access to credit or overdraft services later. So protecting your check history is like protecting your credit score. It all builds your financial story. Here's your recap. A bounce check means not enough funds. Banks can return it and charge you fees. Communication and tracking your balance can stop it before it starts. So next time, before you sign that check, take a second look. Because understanding how banking works means you get it. If this helped you, drop a comment in the comments and tell me, have you ever had a bounce check? And what did you learn from it? Don't forget to like, subscribe, and share this with someone who needs to keep their money in check. Disclaimer: this video is for educational purposes only. It does not constitute financial or legal advice. Always check with your financial institution or qualified professional regarding your specific situation